and on the back of a strong performance of 2024, many of clients would take a sort of a cautious approach into Trump inaugurations. So that's where we are. Some volatilities, probably potentially into the Chinese New Year, but we do expect solid support. If there's any market pullback like currently we're seeing.
Yeah, the policy dead zone or vacuum, as you're saying, gives us just basically the data to work with as far as the markets are concerned, and then perhaps, sort of hinging on also some of these leaks we've heard with regards to Reuters sources, with people familiar with the thinking over in Beijing as to what they might be penciling in for the NPC. How much of that, from what we know now, 5, 4, 3, around 5% GDP growth target, 4% of GDP on the budget deficit, and 3 trillion yuan in the special bond issuance, do you believe that will go far enough to support the markets this year?
Well, the direction to me is very clear since the end of September. So in my view, the economics and capital market policy in China has pivoted into whatever it takes. But it takes time, right? So it takes time for the real economy to reflect those policies. And also it takes time for the policymaker really to identify those levers. So we have been consistently suggesting to the policymaker in Beijing to make sure they really communicate well, whether it's GDP growth, whether it's price movement or unemployment. Just make sure the policy are consistent and predictable. I think they're on the right track. It just needs to take a bit of a time for them to make sure the long-term investor buy into that.
Oh, absolutely. And that's really key, isn't it? And what do you make of the bond market, the record lows, the absolute nosedive on the 10 and 30 year? I mean, certainly as far as what that's telling us about what investors are pricing in right now. I mean, I was speaking to Vincent Chan last week, who said we could be looking at, on the 10 year, sub 2% for 2 years unless the economy responds. We could even go sub 1% in 2025.
Well, without doubt, Chinese treasury market has been, experiencing a bull market from a price, perspective. I think lower yield reflects the lower growth and also the decisive measure from monetary policy front to really bring down the overall cost of funding, which could be stimulative to the economies. And so right now we will see a bit of a rotation from, potentially stock into the bond market. But in the longer run, we definitely see this lower yield environment will be stimulative to the economy and also bring more capital into the stock markets.